So here's our quick roadmap for today's review session. First up, the nonprofit difference. 2, receipts and payments defined. 3, we're tackling the Swaraj Club. And finally, number 4, our exam day review.
All right, starting with section 1, the nonprofit difference. Time to rewire how we think.
You know, before we even touch the math, we actually have to shift our entire mindset. See, if you've been studying your standard corporate accounting, you're totally used to a world where a business exists basically just to make its owners or shareholders wealthy, right? But a nonprofit organization, it's a fundamentally different beast. Its entire purpose, legally and financially, is to operate for the benefit of society as a whole. So because the core motive is providing a service, rather than, just lining people's pockets, the financial statements absolutely have to reflect that reality.
And honestly, that brings us to a super crucial vocabulary shift for your exam. Nonprofits use the term surplus when income exceeds expenditure and deficit when expenditure exceeds income. Literally writing the words profit or loss on a nonprofit accounting exam is a remarkably fast way to lose easy points. So let's make sure we get this terminology completely locked in.
Which naturally leads us to a pretty big question. If an organization doesn't calculate traditional profit, how on earth do they keep track of the literal physical cash coming in and out of the door every single day? I mean, they still got to pay the electric bill, right?
That brings us to section 2, receipts and payments defined. Let's track that cash.
Okay, so this is the exact document nonprofits use to track their daily cash. The formal textbook definition of the receipts and payments account is a summary of the cash book without a date column, and it's used to present periodic receipts and payments along with opening and closing cash balances. Wow. Okay, if that sounds a bit dense, let's simplify it right now. Just think of this account as a cash diary that doesn't care about specific dates. It literally just shows you what cash you started with, what cash came in, what cash went out, and what you've got left over at the end of the period. That's the whole shebang. So, the crucial point is this. This account completely ignores the accrual system of bookkeeping. Throw it out the window. If cash changes hands, it gets recorded. Period. It totally doesn't matter if the cash is for a massive capital asset, like buying a building, or a minor revenue expense like grabbing a daily newspaper. Furthermore, it doesn't even matter if the cash they received is for last year's subscription, this year's, or even a prepayment for next year. If that money hits the bank account, it goes on this statement. No exceptions.
And the best part? The format itself is incredibly simple. It's essentially identical to the standard cash book you probably already know from your earlier studies. Receipts always go on the left side, the debit side, and payments always go on the right side, the credit side. Honestly, if you can just remember, left means money in and right means money out, you're already halfway to passing this kind of question.
All right, moving on to section 3, tackling the Swaraj Club. Let's apply this to a real exam scenario.
Okay, it's time for our boss battle. Here is our raw exam prompt. We're tasked with preparing the receipts and payments account for the Swaraj Club for the year ended March 31st, 2022. Now, on the actual exam, you're going to be hit with this massive, jumbled list of transactions, opening balances, random donations, salaries, all sorts of expenses. It usually looks totally chaotic at first glance, but we're going to use a systematic walkthrough to make it incredibly easy.
So, whenever you face a question like this, Alex, I want you to use this exact 4-step framework. Whatever you do, don't just stare at the list of transactions randomly. Step 1, find and record your opening balances. Step 2, comb through that list and categorize only the money coming in, your receipts. Step 3, go back through and categorize only the money going out, your payments. And finally, step 4, calculate your closing balances to make the whole thing match up.
Let's execute steps 1 and 2 right now on the left side of our ledger. First up, we debit our opening balances. So cash in hand was $200 and cash in bank was $400. Next, we just simply list all the incoming cash. Let's see. We had entrance fees of $300, membership fees of $3,000, a massive $10,000 donation that was specifically for a club pavilion, and $1,200 from selling foodstuffs. Boom! We just list them straight down the left side. Pretty simple, right?
But wait, let's actually test your memory of the rules we literally just studied, just to simulate a little exam pressure. So, we have an $11,000 payment for constructing that club pavilion. Tell me, would that go in this specific account? Even though it's clearly a major capital expenditure and definitely not an everyday operating cost? What do you think?
Yes, it absolutely does. Remember, this account completely ignores the difference between capital and revenue. All cash outlays go on the right side. So for step 3, we're going to credit all our payments. Salaries of $1,200,
purchase of foodstuff for $800, that really hefty $11,000 for the pavilion construction, general expenses of $600, rent and taxes at $400, and finally bank charges of $160. Every single dollar that physically left the building gets recorded right here.
And this brilliantly illustrates exactly what happens when you trust the framework. We total up the left side receipts and we get $15,100. Then we sum up our right side payments, which come out to $14,160. The difference between those two numbers is $940. Now the problem actually tells us our closing cash is $350. So if we subtract that $350 from our $940 remainder, it leaves our balancing figure for the closing bank amount perfectly at $590. Look at that. Order emerges right out of the chaos.
Okay, moving to our final section. Section 4, Exam Day Review. Let's lock this in. Let's lock these key concepts into your short-term memory before you even think about walking into that testing center. Consider this your ultimate cheat sheet, summarizing the big distinctions you will absolutely be tested on. The Receipts and Payments account, it's basically equivalent to a cash book, and it strictly uses cash basis accounting, meaning absolutely no accruals. Now, the other statement you're going to learn about later, the Income and Expenditure account, is the equivalent of a corporate profit and loss statement, and that one does use the accrual principle. Seriously, mix those two up, and the exam is definitely going to dock you points.
Okay, let's do a quick piece of exam trivia pulled straight from the textbook's multiple choice section. Ready? True or false? The sale of grass by a sports club is treated as the sale of a capital asset. The answer is false. Believe it or not, grass is not considered a capital asset for a sports club. It's just treated as a regular revenue receipt. I know it's kind of funny, but they love throwing these highly specific, slightly weird examples at you, so you really got to stay on your toes.
Now, before we wrap up, I want to leave you with a final kind of provocative thought. Since the Receipts and Payments account completely ignores the accrual principle, literally recording everything regardless of what period it actually applies to, does this statement genuinely reflect the financial health of the nonprofit, or does it just tell us that the lights are going to stay on tomorrow? An auditor will be the first to tell you that a really fat bank balance today might just be hiding massive unpaid bills for tomorrow. Just think about that. Think about how this single document provides absolute transparency into cash flow while simultaneously hiding the actual long-term financial reality. Pretty wild, right? Anyway, best of luck on your exams, Alex, and a huge thanks to all of you for joining us on The Explainer.